Hi, everyone. It's Rick Bensignor, and welcome to this week's In the Know Trader Show on StockCharts.com. Well, markets have pushed to, certainly equity markets have pushed to new all-time highs, and lots of people are happy about that, but there's still a fair amount of Wall Street that is not so happy simply because so many portfolio managers weren't positioned for the market to make new highs, and or they were in the wrong sectors for the bulk of the year. And there is a shift going on in PMs going towards the right direction, but with less than 2 months to go now for the balance of the year, you still have a large portion of the long-only crowds who have underperformed this year. Certainly many hedge funds underperform, having been also kind of incorrectly positioned, sometimes even short, and not capturing nearly as much as the markets moved up. As well as the fact that, and this is kind of interesting, is if you think about what the conversation on the street was 2 months ago, it was constantly about the upcoming recession. And notice in the last couple of weeks how you just don't hear that a heck of a lot. Now, part of that has been the move to new highs, which has occurred in the last 2 weeks. Part of it is that the economy still seems to be growing fairly well, and you have low unemployment and low inflation, low interest rates in general. But if you just think back how quickly people can forget or push to the side what was the conversation for so long, it shows you how fickle people are too. And that as long as it's the conversation that's common and everyone's talking about, they're willing to talk about it themselves. And if you think about what you read in the newspapers like the Wall Street Journal, or any business publication, the main TV media stations of CNBC, Bloomberg, and Fox Business, you just don't hear a heck of a lot of people talking about it anymore. And that's really kind of a bias in the sense that we're only paying attention to current news, and just stuff that was just weeks prior seems to fade away. So it's essentially kind of conservatism bias, where we disregard older news for the new news. The new news being that it looks like the U.S. and China are getting closer to at least the first element of a deal, and rates have not broken underneath the summer lows. So that's a good thing, actually, in market terms, in equity market terms, and it's why we spend so much of what we do and what In the Know Trader is all set up to do, is to provide you with the behavioral aspects of the marketplace, so that you get a much clearer view of how to take advantage and essentially exploit a lot of the mistakes that investors make. And those investors are both individual, but also professional portfolio managers. They're the ones who I usually focus on in order to make the biggest calls I do, because when I can surmise that they have made a poor judgment on something and have positioned the wrong way, we often take the other side of that trade. And that's how we frequently are buying low and also selling out of certain recommendations we have on what ends up being the highs of the move right before a pullback. So just to me, something that's important and certainly worth talking about to start today's show. As far as what we're going to do today, we'll do the regular stuff, going over the sector movement, see what's going on 1 week, the current week versus where it was a week ago. We'll take a look at the S&P specifically, just to see what these new highs mean and how far we might go, as well as where are some of the key levels on the downside that would need to hold on a pullback. And then the rest of the show this week, we're going to look at what I call not your everyday commodities. So frequently talk and write about the oil market, the gold market, but there are a heck of a lot of other commodities out there, and they really are let's just say they're not as widely traded. Certainly, most people pay attention in the marketplace to the gold market. Some do to the oil market simply because of the implications of what higher crude oil prices means for everything else. But unless you're in the industry or you're a speculator, you don't often spend a lot of time looking at the grain markets or what are called the soft commodities, which is coffee, sugar, and cocoa, fiber being cotton. We'll look at OJ today, also orange juice futures, and we might even take a look at one or two of the meat commodities. And again, I'm doing this because you just don't find many people who look at them and certainly give advice on them. And so we'll look at the charts, we'll see what they say. And for those of you who are basic speculators in the commodities markets, you'll get a sense of what I'm thinking for those. Just as a reminder before we get into things, best way to contact me is rick@inthenotrader.com. Check out our website at www.inthenotrader.com. Also, lots of information there that you'll find useful about the markets, about how we look at the markets, and how to sign up to be an In the Know Trader client. So that's that. Let's move on to the first part of the week, which is comparing the S&P relative performance up through yesterday's close to where it was a week ago to see what's moving in the market. So we're going to look on the right-hand side here. That's this past week. And any of the 11 sectors that have a red or green dot above or beneath their performance has moved more than 1% in relative performance over the prior week, which was what we show on the left-hand side, which was 2 weeks ago. So in other words, going into last Wednesday's or last Tuesday's in the No Trader show, where they stood there. So green dots mean you've had an increase of 1% or more of relative performance. Red dots are negative. So let's take a look here and see that industrials have now outperformed the S&P by over, what do we have, 5.15%. They were only 3 and 2 last week. So that's moved up about 2% of outperformance. Energy has also picked up something like 2% or so in the last week. Still the worst performer for the year. But in relative terms, it gained 200 basis points or so of performance. And the energy is actually interesting because that's a sector that I think was in September that for the first time this year I started turning bullish on. And it has actually held itself up against the S&P. I'm not sure it's outperformed, but it has not been worse than the S&P dramatically in that time. And that's also of note for those because so many of the names in the energy space are quite cheap. And that's a part of the market that we started looking at in order to do some bottom fishing, as I said, back in September. Consumer staples went from up over 1% to down over 1%. So we've seen over a 2% move, negative move for staples. And that makes sense too, because the market doesn't need to be as defensive, which normally you think of as consumer staples. When consumer staples are leading the market higher, it's because portfolio managers are concerned about growth in the marketplace and they're playing the defensive sectors, and staples are the classic defensive sector. So with the market making new all-time highs as it has in the last week or two, you've seen the underperformance of staples during that time, which makes some sense. So it's fairly flat on the year versus the S&P, just trailing by 125 basis points. What else? We've seen utilities, which were also not terribly outperforming, but they were up 1% and now they're down. Looks like, it's hard to see, looks like about 0.5% or so. So a drop of over 1%. And then lastly, we've seen real estate, which was and still, let's see, it's just barely the second best performer. It looks like that industrials might have just crept in front of them. But for the bulk of the year, technology was by far the best performer, and real estate at some times was the best performer. You've seen a rather precipitous drop in that sector in relative terms recently, simply because rates have started to stabilize, and at least on, when we look at 10-year note returns somewhere in the 1.8 neighborhood gives investors a thought to potentially invest in bonds instead of the income generation that REITs can give you. And the higher rates go, the more they become competition for the REIT space. So we've seen as yields stopped going down, which was, of course, low yields was very good for the REIT sector. As they've crept up a bit, we've seen some profit taking on the REIT side. Still decent returns relative to the S&P, up about 5% versus the S&P this year, but that is well off the highs of what they had been. Okay, so let's start off with the S&P, and this is a live chart. So as we're recording, we're at 3,078 in the S&P. This is a weekly chart. And what we've been talking about for the last couple of weeks is how we did not want to be adding new long exposure until we broke above 3,064. This dotted pink line here, it's kind of light, but you can see it, is the risk level from the weekly 13 that showed up in July. In other words, it's the point at which playing this 13 for exhaustion of trend would say it's no longer exhaustive. You're likely going higher. And of course, when we got to 13, we spent, we sold off a couple weeks later. It's been a good signal, and it's lasted 3 or 4 months of being a good signal, and now we're pushing up through. So it's giving us more reason to think that the bigger overall trend, which is, of course, a bull market that's been in place since 2009, can reassert itself. Now, it has not broken above 3,064 in a qualified and confirmed fashion, which is normally how we'd like to see something break in order to play it. But I also know that waiting for those to occur on weekly charts can often be can take a lot of price movement before it ever happens. So the other piece of this is, as we switch this to a daily chart, is the 13s that we had seen on the daily chart, which also had been the one in July, coincided with the weekly 13 for indicating upside exhaustion, has now also broken out to the upside above the more recent 13 stop out level. So it too would suggest that there's reason for the market to move higher. And that's why kind of not waiting necessarily for all these official signals, but more so playing them as a breakout that I'm willing to put some new capital to work. So we got institutional clients to be buyers early this week. And not that we were ever short or negative the market. We were simply, there's certain times and places that we've been unwilling to be buyers. Also, for those of you who have followed me for some time, you also know that this dark purple line here, my arrow has just disappeared. Let's see if we can get it back. Sometimes we have to play games. Here we go. So this purple line right here, which was at 29.11, although multiple times we traded beneath it, it was never done properly, and that's what kept us long. When many others were selling in the summer, we stayed long, and all we did was simply hold off buying until we started moving up again. And we went, I think it was about 29.50 or so. We went back tactically long and have been adding to those longs since, including this week. So where might the S&P go at this point, and what are some of the key levels beneath us to watch? Well, we'll do the latter ones first. On a daily chart basis, the new number to focus on is 3,029. As long as we don't close beneath this in a qualified and confirmed fashion, then this still would be the nearest support level that we would play off of. In a bigger picture, we're going to go back to the weekly and tell you that in the big picture, as long as we're above 28.79, which is where the weekly propulsion signal is, that we're okay. In fact, that's just because of this week's move, we're actually getting a newer one at 29.36 and high change, so let's call it 29.37. So as long as we don't get Friday close, and this breakout potentially gives us the possibility to go as far up as 33.36 over time. It's could we see that in 2020? We certainly could. You've got an election year coming up, and that's going to change or potentially change the market. The closer we get to election day, whether or not how Trump versus whichever Democrat is ultimately running is going to make a huge difference to how people perceive what would happen over the following 4 years. If it's a Democrat and a very progressive Democrat, the market's not going to like that. And as polls show up leading into election day, you're already seeing negativeness in the market. If the Democratic front runner is also polling particularly well against the incumbent president. If he or she is not polling well, and it looks as if Trump has a significant lead going into elections, then I suspect the market will stay lofty. And as long as the Democrat doesn't win at that point, the market can keep moving higher. So that doesn't mean there aren't bumps and hiccups along the way, but that's kind of basically how I see things panning out over the next year. If we start to break down well before election time, and not because there's a Democrat in the lead, because something else has happened, then we start paying attention to some of these levels. And as I've advised my clients, and I'll say the same to you, client or not, have a game plan in place now in case things fall apart. You want to know where the market needs to break down beneath that's going to have you act regardless of what the situation is at the time. So, and I say that because we know that investors in the heat of the moment, especially when the market is trading off, are not likely to make rational decisions. They tend to wait and evaluate and hope something then comes back. And the market can continually slide, and the losses grow much more. So my clients know which levels I'm looking at to hedge up their long exposure if something goes wrong. And the best way to hedge, for those of you who have portfolios that in some way, shape, or form, they don't have to exactly mimic the S&P, but you want to have a decent correlation to it so that your portfolio tends to move up and down with the S&P. The best way to hedge your portfolio is selling S&P futures, in other words, shorting futures against, which you have to have a futures account and be fully aware of what trading futures implies, and a lot of people don't, so that may not be the single best way, but it's certainly one way. Secondly, sell spiders, short spiders, SPYs, the most liquid traded ETF there is in the marketplace, because that will go down as the S&P goes down, so that'll partially hedge your books. You can also buy an ETF, SH, which trades inverse to the S&P, so it goes up when the S&P goes down. So that's another way to hedge, but realize that you need to spend money that way, in the sense that you need to buy, you need to have money in your account to buy enough coverage to hedge the amount of book of your long exposure that you have. For those, and of course you can buy puts on the S&P using the options market. So several different ways to be prepared and to know how and what you want to do if the market breaks down, so that you have a game plan in place now when you can think rationally when the market's on all-time highs, instead of waiting for the market to fall apart for whatever reason that might be, and then start trying to figure out what to do. So that's what I'll tell you about that. Now, let's take a look at, we said we were going to look at commodities today, and not your typical one. So we're going to start off with the grain market. And this is a weekly chart of corn. So this is, corn is probably the most heavily traded of the grain markets. which has tremendous daily volume. But again, it's more of a niche type of commodity for speculators or food processors and hedgers and farmers and people who are in the corn industry. But plenty of people speculate on these, and therefore we'll go through a bunch of these things here now, a bunch of these commodities. Most important things to look at. I'm kind of liking what I see here as far as weekly 9 counts. This is a set of 9. It called the top. The set of 9 a week before the bottom. This 9 in here called a 1 month decline. And when you're trading futures, a month is plenty. The 13 was the ultimate high of the move, and that, of course, is the exhaustion of trend. Sells down, holds the propulsion level, bottoms into a 9 count, rallies into a 9 count, goes sideways for a month, and then you get much more chop. And then more recently, back in September, you have a 9 on the bottom. So this has been pretty good. Otherwise, you have a very flat 200-week moving average, which is this dark blue line here, which means you don't have any predominant long-term trend. Of interest to me now is corn kind of right where it's trading here at 381 down to 371. This, if you're bullish corn and you think that the 9 count down in here is the bottom, that's more lasting than just the rally that we've had, then this is a zone to potentially be a buyer and looking for a move up to 421. So I'd be mildly bullish corn. There is, of course, a rather significant unfilled gap here. That's probably the rollover of the contract. But I would say, again, anywhere from 381 to 371 may be the area to play for this. Next, let's look at soybeans. January 2020 soybeans. Here's the 200-week moving average. Looks like it nailed the top a couple weeks ago. More importantly is a 13 indicating exhaustion of downtrend. It still traded lower for a few weeks, held the propulsion exhaustion levels, come back, and then recently held what would be a bearish, if this properly broke through this purple line right here at 848, it was at 846 and change, then you would have had a sell signal. It didn't. This is kind of like the S&P in the summer. It didn't break beneath the levels properly, and it turned around and made new highs, and you can see we're up on new 2019 highs. Certainly, we look in the past, you go all the way back in 2016, the 200-week moving average seems to mean something here. It was the peak here. It was some bottoms in here until it broke through. So it wouldn't surprise me, if anywhere from 945 to somewhere around 962, you get some resistance. If it breaks out to the upside, you have targets closer to 11.5 cents. And that would be significant. In here, I guess, let's see if we draw a trend line and what we get from that. So pullback here gets you probably in the 880s or so. I don't see anything really significant. I'm flipped here to a daily chart. 1280. Not much here. Maybe I'd be a buyer near 912 on a pullback. Wheat market. Here's the daily chart. Oh, a couple days ago, possible upside exhaustion. Notice the high up here, upside exhaustion. This 13th showing downside exhaustion would never be looked at because of the straight fall and the follow-up setup. The earliest you would ever look for this is actually here. So you could have actually bought this using the model down right near the lows. Same thing here too. We're kind of caught in between. We're north of the 200-day moving average. And let's look at the weekly. Here's the weekly. All right, so you have a weekly setup 9. It's imperfect because the high of the move was 7, but it gets harder being a buyer. A 9 here on the bottom. The only thing I can say is for those of you who are potentially looking to do something here, you might lean towards being a small buyer here, not big, but you probably could do a little fishing here, playing for a move that takes out the high of 535, just because this 9 count came where it did, and ideally we'd like to see it get higher. So I think there's a decent chance that without a heck of a lot of downside here, we can still possibly get up to test 560, if not all the way up to 585. The coffee market. Actually, coffee's been on a rip recently. So here's the daily chart. This is actually one that I play for a fund that I trade for. We had the 13 looking for exhaustion of trend. We went right down to the propulsion exhaustion level. I got long this day right here on October 18th on the one up. I picked some out on, I think, in here, because if I put a cloud chart up, as we bumped up against the cloud, I took some off, and I've actually just taken off some more now. If we break out to the upside and get up to 107 and change, I'll probably put a little back on with then a chance of playing for as much as 117. But right here, I lifted the rest of my longs right here, literally 20 minutes ago, just south of 106. Sugar. March sugar is actually the closest contract. So that's the front month, even though it's well into 2020. We're getting a little bit of a cloud breakout here today, yet the lagging line still is going to run into some resistance. More importantly is, again, notice that the propulsion level, even though we closed beneath it 2 days in a row, never turned into a sell signal. The bullish propulsion exhaustion level got pushed through today. This to me looks like it's heading higher also. I'm going to test 1324 or so. So I'm kind of friendly towards sugar. I'd be a buyer on small pullbacks to play for that up move. Cocoa. Cocoa is only a day away from potentially getting a 13. That's a daily chart. The weekly chart is, this actually close to breaking out on the upside. It'll be important to see where Cocoa closes this Friday. If we close down on the week relative to the last Friday, so if this Friday closes less than last Friday's close, and then next week we get a Friday close above 25.03, we should still head higher and get a much decent breakout of anywhere from 4 to, I'd say, 10% higher in Cocoa. So there's that, and let's look. We're starting to run out of time. Let's look at cotton at 62.80-ish or so, 62 and a half, 63, somewhere there. So possibly you buy this pullback to play for a higher move. And that's it for this week. We've gone through the half hour really quickly. Thanks for listening. I'm Rick Bensignor. Have a good week.
If you're interested in trading Alexander Elder's Come Into My Trading Room or Trading for a Living book, we have the settings on StockCharts to do that. First of all, the Elder candle style. Then you could use Keltner bands to set up the width. These are adjusted based on the ATR. And the force index, of course, as well as his MACD, or the regular MACD. So here's how you do that. You'd select Elder Impulse System from the drop-down menu on Chart Type. You'd select Keltner channels and pick the width that you want, and it has to be one that fits nicely. And then force index and MACD. And again, the way you pick the Keltner channel width is you want it to just touch the top of most of the primary uptrend bars so you get out just at the right time. Anyway, enjoy trading for a living.